When gross domestic product, GDP, is negative for 2 or more consecutive quarters, the economy is in recession. Recessions can be triggered by various things, such as declining demand, rising production costs, financial crises, or natural disasters. Japan, which has the third largest economy in the world, is facing a recession in 2023. Data released by the Japanese government shows that Japan's GDP fell 0.4% on an annualized basis in the fourth quarter of 2023, after previously shrinking 3.3% in the third quarter of 2023. Some of the things that caused Japan's recession in 2023 include the weakening of the yen compared to the US dollar. The Japanese currency fell by almost a fifth compared to the US dollar in 2022 and 2023. This makes Japanese exports less competitive in the global market, and raises the cost of importing essential goods, such as oil and raw materials. Declining domestic consumption due to the COVID-19 pandemic. The coronavirus outbreak that spread around the world since late 2019 has had a negative impact on economic and social activities in Japan. Movement restrictions, business closures, and rising unemployment depressed purchasing power and consumer confidence. Weakening demand from China, Japan's largest trading partner. China, the engine of global economic growth, is also experiencing an economic slowdown due to the impact of the COVID-19 pandemic. This has affected the decline in demand for Japanese goods, such as machinery, electronics, and automobiles. Production was halted at one of the units of Toyota, Japan's largest automaker. In January 2023, a major fire broke out at Toyota's Aichi plant, which produces about 10% of the world's total Toyota cars. This caused supply disruptions and delivery delays, which impacted Toyota's sales and earnings. Japan's recession in 2023 has a huge impact on the world economy, especially for countries that have trade relations with Japan. Some of the impacts that can be felt include declining exports and economic growth of Japan's trading partner countries, such as the United States, China, South Korea, Indonesia, and Australia. This is due to declining demand for goods from Japan, as well as increasing price competition from cheaper Japanese products. Decreased investment and cooperation from Japanese companies in other countries. This is due to declining profits and liquidity of Japanese companies, as well as increasing uncertainty and risk in the global market. Declining exchange rates and foreign exchange reserves of yen-dependent countries. This is due to the weakening of the yen against the US dollar, as well as declining capital flows from Japan.